Good morning, everyone. This is Luis Concepcion with Strategic Profit Line Trading. Today, I'll be going over how to sell a covered call and what a covered call is. Today, I'll be using the TD Ameritrade platform, and this is a chart of the S&P 500. I'm on a daily chart, and I've pre-selected two price points. So before we begin, let me explain to you what a covered call is. So a covered call is a transaction in which the holder of a security sells an option contract on shares they already own. So I've selected the S&P 500. So we're going to pretend that we purchased 100 shares of the S&P 500 at $400 price point. Once again, in order to sell a covered call, you must own at least one shares of the security stock or the underlying that you're trading. Now, let's say we have a predetermined price profit target of 425 where I put the secondary line. As you can see, since the S&P 500 hit $400, it's been going up for a couple of days, and now all of a sudden we have dropped back down to 412. So selling covered call is a way to generate weekly, bi-weekly, or monthly cash flow with that predetermined price point of 425. So let's go ahead and say we want to generate income in 2 weeks. I'm going to select the 17th February, which is 12 days away. I'm going to bring this back down. Remember that calls on the left-hand side of the screen. Now remember, we've selected already a predetermined target of $425. So I'm going to scroll down to the strike price of 425. And when we get there, I'm going to go to the left-hand side of the screen because that's calls. And you can see that if I go ahead and sell, you can see it very small below my cursor, the 425 strike, our account is going to automatically be credited $132. So you can see we're going to sell. I changed this from our default from 10 to 1 because we only own 100 shares. That's in P500, 17 February, and our account is automatically going to be credited $132. So what does this mean? We come back to the charts. What has to happen between now and 17 February is that in order to keep both our shares and the premium, price needs to stay below $425. By selling a covered call, we are obligating ourselves to sell our shares at a certain price point, and we've selected 425. So if between now and the date you select, price stays below 425, we keep our shares and we keep our premium. Now, if price happens to go above the $425, we keep our credit or premium of $132. However, we will lose our 100 shares. So once again, if price goes up to 425 and exceeds 425 before our expiration date, we will lose our shares and keep our credit. However, if it stays below our strike price of 425, we will keep both our shares and our credit, and we could continue to do this on a bi-weekly, monthly basis until our shares get called away, hence a covered call. So once again, 12 days away, we can go ahead and earn a premium of $132. And let's see if we went out further. See if we went out 33 days to 10 March. Scroll down to 425. And now instead of $132, we can make $342. Once again, I'm going to change this default to 1 because we only own 100 shares. And our account, if I hit confirm and send, we would get credited $3.42. And that is how you sell covered calls against positions you already own, a minimum of 100 shares. And if you happen to own more than 100 shares on any one underlying stock or asset, you would just simply sell the appropriate amount of contract for the appropriate amount of shares that you own. And This is how you can generate cash flow by selling covered calls on a stock that you own. I hope this information was informative. Thank you very much. Till next time, happy trading.